If the stock market crashes in the next few months, most retail portfolios are going to be absolutely slaughtered. Warren Buffett is currently sitting on a historic mountain of cash, which is the loudest warning signal you will ever see. While amateur investors are still chasing hyped-up tech stocks at all-time highs, the smart money is sprinting towards safety. A market correction is not just possible. It is mathematically inevitable when valuations disconnect from reality for this long. Today, I am breaking down 5 fortress stocks that are specifically built to survive and thrive during a recession. These companies have the pricing power to beat inflation and the balance sheets to withstand a total economic collapse. We are going to analyze exactly why these 5 stocks are the ultimate insurance policy for your wealth right now. I will also give you a specific portfolio allocation strategy at the end to help you balance risk and reward. You cannot control what the Federal Reserve does with interest rates, but you can control what you own. Let's start with the first stock, a retail giant that actually makes more money when the economy gets worse. Stock number 1 is Walmart. Walmart is the ultimate countercyclical play because of a phenomenon known as the trade-down effect. When a recession hits and people lose their jobs, they stop shopping at expensive stores and start buying groceries at Walmart. This creates a natural revenue floor that protects the stock price when the rest of the market is falling off a cliff. But the real story here is not just groceries. It is their high-margin advertising and e-commerce business. Walmart has successfully built a digital fortress that is finally competing toe-to-toe with Amazon in delivery speed. They are using their massive store network as fulfillment centers, which drastically lowers their shipping costs compared to competitors. The main risk to watch is valuation, as investors have already bid up the price because everyone knows it is a safe haven. However, paying a premium for a company that can grow earnings during a recession is a strategy that pays off. Stock number 2 is a legendary brand that possesses what Warren Buffett calls unparalleled pricing power. Stock number 2 is Coca-Cola. In an inflationary environment, the most important trait a company can have is the ability to raise prices without losing customers. Coca-Cola has proven time and again that they can increase the cost of their drinks, and consumers will keep buying them. This makes Coke one of the most effective inflation hedges in the entire stock market. They are a dividend king with over 60 consecutive years of dividend increases, providing reliable income rain or shine. That dividend cash flow is critical during a crash because it gives you fresh capital to reinvest at the bottom. The risk here is limited growth. You're not going to see tech-like returns, but you are also unlikely to see tech-like crashes. Recent consumer data suggests some pushback on prices, but Coke's global volume remains incredibly resilient. Stock number 3 combines boring utility stability with the explosive growth potential of artificial intelligence. Stock number 3 is NextEra Energy. NextEra operates the largest electric utility in Florida, providing steady, regulated cash flow that is virtually guaranteed. But they are also the world's largest producer of wind and solar energy, positioning them perfectly for the future. The rise of AI data centers is creating a massive spike in electricity demand that the current grid cannot handle. Big tech companies are desperate for clean power to run their servers, and NextEra is the primary supplier for that demand. The stock has been volatile due to high interest rates, which make their debt more expensive to service. However, as interest rates eventually stabilize or come down, this stock has massive room for capital appreciation. You are essentially buying a bond-like utility with a tech growth kicker attached to it. Stock number 4 is a healthcare titan that is statistically safer than the United States government. Stock number 4 is Johnson & Johnson. This company is one of only 2 in existence with a AAA credit rating, meaning they are incredibly unlikely to default. Healthcare is the ultimate defensive sector because people cannot choose to skip their medical treatments during a recession. J&J has spun off its consumer division to focus purely on high-growth pharmaceuticals and medical technology. They have a robust pipeline of new drugs that ensures their revenue will continue to grow for the next decade. The major risk here is litigation, specifically the ongoing lawsuits regarding their talc products. This legal fear has kept the stock price depressed, creating a rare value opportunity for long-term investors. If you can stomach the headlines, you are buying a fortress balance sheet at a significant discount. Finally, stock number 5 is the ultimate sleep well at night, holding for any nervous investor. Stock number 5 is Berkshire Hathaway. Owning Berkshire is like owning a slice of the entire American economy, managed by the greatest investor of all time. The company sits on hundreds of billions in cash, which is their secret weapon during a market crash. When the market collapses and liquidity dries up, Berkshire steps in to buy amazing companies at distressed prices. While other investors are panic selling, Warren Buffett and his team will be panic buying. This optionality means that a stock market crash is actually a good thing for long-term Berkshire shareholders. The stock also provides exposure to insurance, energy, and railroads, creating massive diversification in one ticker. The risk, of course, is the age of Warren Buffett, but the succession plan is already firmly in place. So, how should you structure a portfolio with these 5 defensive heavyweights? I recommend allocating 30% to Berkshire Hathaway to act as the stable core of your portfolio. Put 20% into Walmart and 20% into Coca-Cola to capture the resilient consumer spending. Allocate 15% to NextEra Energy for income and AI-driven growth upside. Finally, put the remaining 15% into Johnson & Johnson to cover the essential healthcare sector. This allocation gives you a blend of growth, income, and extreme safety that can withstand any recession. The goal is not to double your money in a month. The goal is to ensure you still have money when the dust settles. Investing is a survival game, and the investor who avoids the big losses is the one who wins in the end. If you are worried about the crash, stop gambling on speculation and start building a fortress. If you found this breakdown helpful, please hit the like button and subscribe for more honest market analysis. Comment below and tell me, are you buying a dip right now, or are you sitting on cash like Warren Buffett? In the next video, I am going to reveal 3 dividend ETFs that pay you monthly income. So turn on your notifications. Stay disciplined, protect your capital, and I will see you in the next video.
Thank you for joining us. Goodbye for now, and we'll see you soon.